Oke, Assalamualaikum warahmatullahi wabarakatuh. Introduce, my name is Madina Lisa from Economic Education Study Program. Student ID numbers 18052007. In this section, I will explain the result of the analysis, calculate, and determine the money supply. Well, the first, understanding the classical demand for money. Demand for money. Desire to hold cash deposit and liquid asset or wealth in the form of money. Liquidity. Degree to which an asset can be readily converted to spendable cash without a significant loss in value. Transaction demand for money. The desire to hold money to purchase goods and devices, for example, chair, television, and motorbikes. The greater the value of transaction a person makes, the more wealth that person needs to hold on in the form of money. Precautionary demand for money. The desire to hold money in order to pay for emergency expenses, for example, mechanic and ambulance. Asset, for example, stock, house, and gold. If individuals do not diversify their wealth holdings, it may result in a significant financial loss. And then, speculative demand for money. The desire to hold money to be able to purchase financial assets at the appropriate time or to hedge certain current financial risks. The next second, understanding the demand for money according to Keynes. It means the demand for money is the desired holding of financial asset in the form of money, that is cash or bank deposit. There are three approaches to demand for money. The first, classical approach. According to classical economics, people demand money for transaction purposes, that is, to carry out their economic transaction over a period of time. The main aspects of the classical approach are as follows. The first, money is demand as a means of payment. The second, the amount of money demanded depends on the volume of transaction and price level. The third, the change in the velocity of circulation of money changes the quantity of money demanded. The next, the classical approach can be explained in terms of Fisher equation of exchange, which has been set below. MV equals PT, where M is money supply, V is transaction velocity of money, P is price level, T is transaction, PP is demand for money, and MV is supply of money. The second, neoclassical approach. It means, according to this approach, people wish to hold down to a certain proportion K of national output in the form of money. There is a proportional relation between the demand for money, MD, and the money value of national output. The demand for money can be expressed as follows. MD equals KY. MD is demand for money, K is constant proportion of Y is money value of national output. The third, Keynesian approach. It means Keynes' approach to determine the demand for money is based on money to important function, medium of exchange, and store of value. Keynes lists the following three motives for holding money. Well, the third, calculation of money demand for transaction, precaution, and speculation. The first, transaction motive. This motive refers to the demand for money by the public for making and changing in transactions of all kinds. The amount of money held for the transaction motive depends on the following factors: the first, level of income; the second, time interval; the third, price level; and the fourth, volume of employment. The next, the transaction motive is further classified as follows. The first, income motive. It refers to the transaction demand for money by earners of wage and salary to carry out transactions of all kinds, such as rent payment and electricity bill payments. Money held for this purpose declined over the income interval period, the income at the end of the period being zero. For example, an employee receives a salary of 20,000 every month. His monthly expense include rent, food, movies, books, and stationery. In the first month, he deposits 20,000 in the bank. This money is withdrawn for various purposes, and the account runs down to zero over the course of the month. The next, the second, business motive. It refers to demand for money by business firms to carry out their day-to-day transactions such as payment of electricity bills, rent, raw materials, and wage. The money held by the firm declines over a period of time. For example, Uber has raised USD 11.5 billion in capital up to 2016. It is raising funds for new global expansion to prepare itself for the rising number of regulatory battles and for its aggressive price cutting and marketing promotion. The next, the second, precautionary motive. This motive refers to the desire of people to hold on to cash balances for unforeseen contingencies such as sickness and accident. Similarly, businessmen keep cash in reserve to survive unbearable conditions or to gain from unexpected fear. The transaction and precautionary motive of holding money are primarily influenced by the level of income. For example, an earning member of a nuclear family may invest in an LIC life insurance product to cover his or her risk and unforeseen events. Thus, in the event of his or her death, his or her family will receive the maturity amount. The third, speculative motive. Speculative simply means guessing the change in value of an asset to make profit. It relates to the desire to hold on to one resource in liquid form to take advantage of future change in the interest rate or bond price. It is also called asset demand for money and is related to the store of value function of money. It is income elastic. At higher rate of interest, less money is held for this motive and vice versa. The change in the market rate of interest and security price can be expressed as follows. P equals R by F into N when P market price and M is market rate of interest N is original price of the security. For example, if R 10% and M is 15%, then P equals 0.10 by 0.15 into 100 equals 66.66. People do not hold on to cash when the rate of interest is high because of the following reason. The first, the opportunity cost of holding idle cash is high. The second, security price at the time of high interest rate are low, which induce investors to purchase them. Thus, the speculative demand for money depends on the rate of interest. There is L2 equals function R, where L2 is speculative demand for money, R is rate of interest. L2 and R are inversely related. And then, okay, we go into the total demand for money. The total demand for money is expressed as follows: MD equals L1 of Y plus L2 of R. MD is demand for money. L1 of Y is demand for money due to transaction and precautionary motive, but being an increasing function of income level. L2 of R is demand for money due to speculative motive, a declining function of interest rate. In Keynesian terms, the total demand for money can be expressed as follows: MD equals L of YR. Well, the last one, the determinant of demand for money. Therefore, the determinant of the demand for money, the first price level. Assuming full employment and a constant volume of transaction, the demand for money depends on the price level. Realizing the assumption of full employment, the demand for money is determined by the price level P and the volume of transaction T. There is PT. The second, income. The transaction and precautionary demand for money depend on income. Higher the income, the more risk the money held for, such as motive and vice versa. The third, interest rate. When people hold on to cash idle balance, they incur an opportunity cost in terms of foreign interest. The demand for investment in various assets depends on the interest rate. The demand for money for motive other than transaction and precautionary is a function of the rate of interest and is inversely related to the rate of interest. And then, velocity of circulation of money. The demand for money and the velocity of its circulation are inversely related. Okay, that's all presentation I can explain. Thank you for your attention. Assalamualaikum warahmatullahi wabarakatuh.